Imagine waking up one morning and realizing the financial world you trusted your entire life wasn't actually stable. Not collapsing in flames, not crashing on headlines, just quietly cracking beneath the surface. No sirens, no emergency broadcasts, just numbers moving in places most people never look. Because history rarely announces its turning points in real time. The fall of empires, the collapse of currencies, the end of economic eras almost always feel ordinary while they're happening. But years later, historians circle a specific moment and say, that was it. That was when the illusion ended. This week in February 2026 may become one of those moments. Welcome to Sleepless Historian Explained, where we don't just talk about history after it happens. We study the signals while it's still unfolding. For years, the public was told the global economy had mastered the impossible. Inflation could be controlled. Growth could be engineered. Debt could expand forever because central banks understood the system better than anyone before them. The phrase soft landing became a promise repeated so often that it started to sound like a law of physics rather than a prediction. But beneath the reassuring speeches and confident headlines, the machinery of the financial system has been telling a different story. And if you know where to look, the warning signs are not subtle. This morning, deep inside the overnight funding markets, where banks lend to one another, liquidity conditions flash signals that haven't been seen since the most stressful moments of modern finance. These markets are not glamorous. They don't trend on social media. Yet they are the pipes that keep global money flowing. When those pipes start shaking, the problem isn't theoretical, it's structural. What we may be witnessing is not another routine market correction. It may be the early phase of a regime shift, the kind that only becomes obvious once it's already irreversible. To understand why, we have to step back and look at the foundation of the last 4 decades. The modern financial era was built on 3 pillars: cheap energy, cheap manufacturing, and cheap money. Energy flowed reliably from resource-rich regions. Manufacturing scaled across Asia, driving down consumer prices worldwide. And most importantly, borrowing became easier and cheaper year after year as interest rates steadily declined. That environment shaped everything. Governments borrowed more because debt servicing became manageable. Corporations borrowed more because financing expansion was inexpensive. Households borrowed more because mortgages, credit cards, and loans seemed affordable. Entire investment strategies were built on the assumption that money would continue getting cheaper indefinitely. But structural trends do not last forever. Energy security has become uncertain in a fragmented geopolitical landscape. Global supply chains are reorganizing around resilience instead of pure efficiency, raising costs. And interest rates, after decades of decline, have reversed direction in response to persistent inflation pressures. When the cost of capital rises after 40 years of falling, the consequences ripple through every layer of the system. The classic portfolio model that balanced stocks with bonds relied on one crucial assumption. When economic stress hit, central banks would lower interest rates, bonds would rise, and they would offset stock market losses. That relationship worked for decades. Investors came to see it as natural. But in a world where inflation remains volatile, central banks cannot always cut rates aggressively without risking further currency depreciation. Suddenly, bonds stop behaving like protection and begin acting like another source of instability. The asset once considered the safest foundation of the financial system starts transmitting risk instead of absorbing it. This leads directly into the trap economists call fiscal dominance. In simple terms, fiscal dominance occurs when government debt becomes so large that monetary policy is no longer guided purely by economic conditions. Instead, it becomes constrained by the cost of servicing that debt. If interest rates remain high, government interest payments surge, straining budgets and forcing difficult political decisions. If rates are pushed lower to ease that burden, inflationary pressures can intensify, eroding purchasing power and undermining confidence in the currency. Either path carries consequences. And when both options are painful, policymakers find themselves navigating a narrowing corridor with little room for error. This is why the bond market has become the quiet center of global attention. Government bonds are not just investment assets. They are the primary collateral underpinning the financial system. Banks use them to secure short-term funding. Institutions use them as the backbone of risk models. Pension funds rely on them for stability. But when bond prices become volatile and yields swing unpredictably, confidence in that collateral weakens. Lenders demand more security. Borrowers scramble to meet those demands. Liquidity tightens, not because money disappears, but because trust begins to thin. That dynamic often shows up first in the repo market, where institutions exchange high-quality securities for short-term cash, often overnight. When repo rates spike or funding becomes scarce, it signals that participants are becoming cautious. Cash is being hoarded. Counterparty risk is being reassessed. The system becomes less fluid. Most people never hear about these shifts because they happen far from public view. Yet historically, stress in these funding markets has preceded larger financial disruptions. They are the early tremors that sometimes arrive before the earthquake. At the same time, the global debt landscape is approaching a critical phase. Enormous volumes of corporate and sovereign debt issued during the low-rate years are approaching refinancing windows. Rolling over that debt at significantly higher interest costs changes the math dramatically. What once looked sustainable suddenly looks heavy. For corporations, higher refinancing costs compress profits and reduce hiring or investment. For governments, rising debt servicing crowds out spending on infrastructure, social programs, or defense. For households, higher borrowing costs reduce consumption. Multiply that effect across economies, and growth begins to slow even as financial pressure increases. This combination, slower growth alongside persistent inflation, creates the environment economists call stagflation. It is one of the most difficult scenarios to manage because the traditional policy tools pull in opposite directions. History offers a partial parallel in the 1970s when inflation surged while economic growth weakened. But today's situation carries an additional complication. Debt levels relative to economic output are dramatically higher across most advanced economies. That limits how aggressively policymakers can raise rates without destabilizing the fiscal position itself. Beyond economics, there is also a geopolitical shift unfolding. For decades, the global financial system revolved around the dominance of a single reserve currency and the network of institutions built around it. That system enabled large deficits to be financed smoothly because global demand for safe assets remained strong. Now some nations are diversifying reserves, increasing gold holdings, and exploring alternative settlement systems for trade. These moves do not signal an immediate collapse of the existing order, but they do indicate a gradual evolution toward a more multipolar financial landscape. Even small shifts in reserve allocation can influence long-term demand for government debt, especially when supply continues expanding. All of these forces feed into the psychological dimension of markets. Humans are naturally biased toward expecting continuity. If asset prices have risen for decades, it feels reasonable to assume they will keep rising. If financial crises were followed by rapid recoveries in the past, it feels comforting to expect the same outcome again. This tendency, often called normalcy bias, can delay recognition of structural change. Markets, however, are forward-looking. They adjust not only to current data, but to expectations about future stability. When confidence in long-term assumptions weakens, capital begins shifting quietly at first, then more visibly. You can sometimes see this in the behavior of real assets. Physical commodities, land, or precious metals attract attention during periods when investors seek stores of value less dependent on financial intermediaries. Even digital assets have, for some participants, become part of that search for alternatives, though they carry their own volatility and risks. Importantly, in moments of acute stress, nearly all assets can fall simultaneously at first. Investors sell what they can to raise liquidity. Eventually, people and institutions start behaving differently. made it this far, you already think differently than most. And remember that history never sleeps, and neither do those who study it closely.